Now, currency markets are no strangers to sudden jolts, with at least 3 flash crashes in the past 2 years. And when it happens, well, the currency market is so disjointed, it becomes difficult for banks to trace erroneous trades. Cobalt DL, a London startup, is aiming to use the technology behind Bitcoin to simplify this very issue. We spoke with Cobalt DL CEO Andy Coyne from London.
Cobalt DL set out to focus on cost reduction and risk reduction for the institutional FX market. Ironically, there's a lot of investment in the FX markets gone into execution, but little into post-trade, which hasn't really changed in decades. So post-trade, we thought, deserved a look, and also the fact that the banks were now more focused on costs than they ever have been. So cost and risk reduction was really the primary agenda for the banks, and we thought that a shared distributed ledger was a way of making that actually happen. It is the newest concept to come to the market, although we believe that this could have been done a long time ago, because the reality is FX is a very, very good use case for a shared infrastructure.
So actually, does the arena become less fragmented through adopting this sort of digital form of settling trades? It feels like there are many people, many companies that could win out with their own form of technology. Does it actually become less fragmented as an industry?
I think that's right. I think the industry gets an opportunity to create effectively utility that takes care of things that institutions like banks do not differentiate on. They don't necessarily make money out of post-trade. It's a cost that they have to bear. It's an ultra expensive cost. We're talking about tens of billions of dollars of expense across the industry. There's a great opportunity to create something more utility-like, where certain services are provided to that utility, whether they're by Cobalt DL or third parties. We're very open to a very flexible infrastructure. The key here is to normalize transaction data across the industry so that everyone's working from the same common denominator, if you like.
So they're all speaking the same language. Tens of billions can be saved in FX. What other asset classes could this be applied to, do you think?
I think the principles are the same no matter what asset class you look at. There are different workflows, different elements to the asset classes that have to be taken care of. It's very important that I think these concepts can translate very easily to other asset classes. However, I think domain expertise is very important here. You've got to have people who understand how the industry works. I've spent all of my career in the post-trade FX space. I've got a very clear idea of what needs to happen, how transactions behave during their life cycle, all the way through up to finality. So domain expertise is very important, but I do think that in terms of the different asset classes, I think there will be a coming together of concepts and ideas about how to use this technology.
So Andy, I'm looking here, say I'm a VC, I'm sat in the Bay Area, and I'm looking at what's coming out of the United Kingdom in terms of fintech. I want to get into this space. I can see that maybe banks are going to adopt this. How much more money is going to be coming into your industry to help finance companies such as yourself, do you think?
Well, I think there's been a lot of money going into fintech in the last few years. I think that's widely accepted. I think now the VCs are really looking for meaningful use cases that are going to be game-changing in terms of changing the way markets operate. So there are a lot of companies that are focused on specializations, whether it be regulatory reporting or other services. This is an infrastructural play that we're working on, and it really is, and I think it's really a game changer in terms of the way the market operates. This is more, as I said, utility-like versus what the banks are currently doing today, which is, running their own internal ledgers and multiple copies of the same transaction. I think the VCs themselves are, becoming much more aware that there are some very real applications of this technology. It's less theoretical than what used to be.
And so how will you prove to them that you've won out when it comes to the market share? Will it be signing certain key clients? Will it be adoption across a certain amount of the market, say 5 billion that's being traded in spot FX at the moment? How much of that pie do you need to get to show that you're the horse that needed to be backed?
Yeah, critical mass is key. Winning Citi as a client and investor is very important. I mean, that's really is an endorsement of what we're putting together. We have other institutions joining the beta that we're working on. So I think critical mass is always going to be part of it. Any shared ledger, it doesn't matter what asset class we're talking about here, any shared ledger requires critical mass to get the most out of it, which will drive the cost further down. It'll allow more and more services to be effective. So that is our goal. Critical mass. Without critical mass, it doesn't really work.